Uh-oh. Well, not work as intended. Okay, we'll get this right one of these times, right? Okay, let me. Okay, we go live. Cool, cool, cool. Now we're live on Instagram, on Facebook. Let's pop over and check the feed. All right, cool. I don't know how often questions are going to be updated on there, so that's something that we'll just have to see. All right. And last but not least, we have a couple more minutes, see if anybody joins in before I get talking. Right. What is going on, everybody? Happy Friday. Stanley. Oh, he doesn't want to be in the video. He said no. But so we are back at it again over on YouTube, streaming live, Facebook as well, and Instagram. Today, I thought we could talk a little bit about some bank statement loans, switch it up a little bit because I want to focus on all types of investment lending. And so bank statement loans is a very good avenue. Okay, so let me keep this open. All right, cool. All right, so bank statement loans, another type of investment loan, and it's going to be not looking at your tax returns or W-2s. It's actually going to be qualifying off your bank statement. So that's a plus for this. So again, it's going to be one of those loans that's really tailored to someone with variable income, maybe someone in a sales position, or investors. So with bank statement loans, you can use them for a primary or investment residence. So you do have options. For self-employed borrowers, business owners, freelancers, gig workers, people with fluctuating income. So real estate investors, entrepreneurs, business owners in general. And they work by going off 12 to 24 months of your bank statements. And so they will look at that period. Let me double check this before I spew on all this information. Okay. Hey, BJ popped in here over on Instagram. All right, bank statement loans, going to be looking at 12 to 24 months of those personal or business bank statements. And lenders are going to be looking at the deposits, so your gross income, to determine your qualifying income. And so if you're having, maybe some large deposits that are going in there, it's a high possibility that they're going to be scrutinized, because they don't need to really source it, but no tax returns, no W-2s, no pay stubs. LTV ratios can go up to 85 or 90% for purchases. Higher interest rates compared to conventional loans because of their risk. So all of these loans, being that they are investment properties typically, and they're not using your personal income to qualify, that just makes them a little bit riskier all around. And so that's why you're typically going to have a higher rate. And so in this case, they're not even using your, like a DSCR loan would be going off your cash flow. And so that's one of the ways they qualify you along with your credit score. And so your credit score is also going to matter here as well. So that's definitely something that, if you want to get one of these loans, if you want to get any type of investment loan, it's always a good idea to work on your credit a little bit first if you need to. You know, um, I'll tell you what, I'm going to do a little more research on bank statement loans before I go after this. That is totally fine. Go back to my DSCR spiel. I'm going to come back and I'm going to watch this in the future, and I'm going to be like, wow, back then I had no idea what I was doing. It's going to be a good time. And so today, this is going to be like my little personal vlog in here. What did I do today? Today I had a great accountability meeting this morning. Really helped me clear some things up. If you don't have an accountability group, you definitely need to get yourself one. Really, really helpful. Shout out to Kevin. You know who you are. Helped me work through some things that I was feeling a bit overwhelmed with last night, and get on a game plan to help stay consistent. And I'm really hoping that over these next 2 weeks, as we head into this new year, that I can take some time to really focus on one task every day and knock some things out. I want to. The new year has already started, but I want, once the calendar rolls around, I want to be in gear, moving, grooving, and all that good stuff. Still working on the property in PA, just waiting to get an email back. As a matter of fact, I'm going to check on that real quick. Got to stay proactive, right, people? It's got some new programs. I'm not sure what those are, but I'll definitely be checking those out later. That is very interesting. All right, let me shoot a little message real quick. Cool, cool, cool. You know, that's actually something that I'm going to. Oh, Jillian, what's going on? I see you were over on Facebook. Currently, I'm working on a duplex helping some local Sub 2 students, Sub 2 members. So there's a meetup over at Antietam Brewery in Hagerstown. And Andy Hill and Brandon Thomas are setting that up. So it's been really great time over there. And so I'm helping them secure a 3-unit with a DSCR. It's going to be a Morby method. And so we're working through that now. I'm pretty excited because this is going to be my first one. And I'm definitely grateful that they gave me the opportunity and are going to be, you know, a little bit more patient while I am learning the ropes. So super excited there. But let's talk about some DSCR, because that is what my current focus is. As a mortgage broker, I'm focusing more on the investment lending side of things. And so that's going to be a lot of loans that aren't going to require digging into your personal income. And so there's not going to be any W-2s. There's not going to be any tax returns. For instance, the DSCR, that's based on your property's cash flow and your credit score. A lot of these loans will still use your credit score. And then, of course, so some are recourse, some are non-recourse, meaning that if it is a recourse loan, they will eventually hit your credit if you're not making those payments. But there are non-recourse lenders as well. So if that is something that you were actually considering, because until I heard of it, I didn't really know that was a thing, that's something to look into. All right. But there's also bank statement loans, which, as the name suggests, uses your bank statements, usually like 12 to 24 months. It depends what lender you're working with, but they look at your bank statements to calculate your income. Asset qualifiers uses your assets. Super creative names, I know. And so I have a hard money lender as well. So I'm interested to try them out. I've heard great things about them actually in the past about year. And I actually, starting out when I was like not a mortgage broker and I was trying to do some wholesale, I actually met one of their reps at one of the meetups I was attending in Maryland. So that was pretty cool. Who knew we'd be working together? You never know who you're going to meet. So yeah, let's get into it. Talk about some debt service coverage ratio. So these are going to be loans that qualify you based on the property's income and not your personal income. So they're going to be great for people with variable income. If you're in a sales position, if you're a real estate investor, if you're wholesaling, you're getting burst of cash and then maybe nothing. So these are going to be great loans because they're not using that personal income. A strong credit score is better, but you don't need a super high credit score for these loans. I have lenders that will go down to a 575. Now, of course, it's probably going to have higher rates on it. So if you can get your credit score up before applying for one of these loans, that can definitely be of benefit. If we're looking at like a minimum kind of credit score ballpark range that you might want to be in, I would say at least a 620. That's about where most lenders have their cutoff. And so DSCRs are business purpose loans, and they do not include any rehab funds. And so, pretty commonly they're used in conjunction with hard money loans, doing methods like the BRRRR. Okay, so that's when you buy, rehab, rent, refinance, repeat. You've all probably heard it from, bigger pockets. And so, once you fix up the property with the hard money, you can refinance, pull that cash out, and use that for your next investment property. Jillian, do you help wholesalers and investors? Investors primarily. In terms of wholesalers, I was looking into EMD, double close lending. It's not going to be my main focus, but if you need help with that, I can definitely get you connected with some pretty reliable people. So yeah, the BRRRR method, rehab, flip the property, refinance, repeat. Okay, cool. So let's talk about actually calculating that DSCR ratio. And that is going to be, I'm actually going to put it in the comments so we actually have an example. So if you have, when you're calculating that ratio, you're using your payments divided by you're using your cash flow divided by your debt payments. And so you take your gross operating income, and then you subtract out any operating expenses, and that's your net operating income. And so you take that and you divide it by your debt payments, which is going to be your principal, interest, taxes, insurance, any associated HOA fees, right? And so with that, let's say you have $2,000 in income, right? And your debt payments are going to be $1,800. So you divide that, and that's going to give you a DSCR of 1.11. And so the thing about these, loans is that lenders want to see, at least a 1, because that means you're breaking even. Just hang on, just post these in the comments. Above a 1, or a 1 means you're breaking even. Above a 1 means that you are cash flowing. Okay, so if you have a 1.1, 1.2 or higher, that's pretty solid. So that can help you get a lower rate if your cash flow is strong. Now you can also go the opposite direction. Some lenders do go into the negatives, and then there's a thing called no ratios. So typically, those are negative cash flow situations. And so you might have a higher rate, but if your game plan might be appreciation, so you're looking at it long term. So it's always best to have a solid exit strategy or some type of plan in mind when you're looking at those negative cash flow situations. All right, check around for some questions. You guys can, feel free to stop me anytime. I will just keep talking. So, as I stated before, no W-2s, no tax returns, great for self-employed individuals. When it comes to scalability, you can actually have as many of these loans as you want. And so when it comes to a FHA, a VA, a conventional loan, something of that nature, you can only have about 10 of those loans before banks look at you as being too risky to lend to. And so with DSCR, there is no restriction like that. Reason being is because these loans actually fall outside of Fannie and Freddie's guidelines. And so they are considered non-QM loans, which is a non-qualified mortgage. If you were like a FHA, FHA, VA, conventional, those are QA loans, qualified mortgages. QM loans, qualified mortgages, they fall within those guidelines. And so there's no cap on the amount of these loans you can have, which means you can, you know, have thousands potentially, if that's your goal. And then you can use these on a variety of properties. So single family, multifamily, commercial, mixed use. Um, I will say with mixed use, you want to, you know, if that residential side is going to bring in, you know, more cash flow and it's a larger part of the property, a DSCR is probably going to be your best bet. But if, you know, the reverse is true, then you might want to look into a conventional commercial loan, because that might just suit your needs better. And so typically DSCRs are going to be 30-year fixed. These are long-term loans, but they also have interest-only options if that's something that you're looking into. Maybe you're newer, maybe you are a newer investor and you're trying to keep your trying to boost your cash flow and keep those payments lower at first. So there's options like, you know, say you have a 5-year interest only period, and then it'll switch over to, you know, a 25-year fixed or something similar. So there are definitely a lot of options. There's also 15 years, there's 40 years. So it really just depends on what you're looking for. And then of course, you know, all these lenders are offering, you know, a little bit different things. So it's definitely good to shop around if you can. I mean, that's what I'm here for, to do that for you. So we have about 30 or more different lenders at our shop. I'm half tempted to go count, but I also don't want to, so I won't. Okay, cool. So, some common misconceptions is that your credit score is not going to be used, or not that it's not going, well, I guess that frequently does come up in some of my conversations, that people are surprised that they do use the credit score. But it's that really that you need a high credit score to qualify, which you don't. You can qualify with a credit score as low as 620. I have a lender that goes to 575, but obviously the rates on those probably going to be a little bit higher. So the better you can get your credit score, the better this could work out for you. And you know what I definitely want to try to do in the future is maybe partner with some credit repair companies, and so we can help some people get qualified. And with DSCRs, get into investment properties, and maybe with bank statement loans, get into primary residences, because you can use those as well. With DSCR, you cannot live in the property because these are business purpose loans. Loans only being for seasoned investors. I mentioned briefly that you can use these, or first-time investors can use these, although some lenders do impose certain restrictions. And so that could be like a 5% LTV reduction or something similar. And then I briefly mentioned that they don't include the renovation costs. So if you have a property that you need to fix up and get it to standard, then you're gonna want to get maybe some private money involved, hard money lender, something of that nature. But a DSCR will not work specifically for your rehab funds, specifically for fixing up the property. I feel like I should make that a little more clear if it wasn't. So when you're looking at boosting your DSCR ratio, just hop around a little bit. Okay. Make sure I didn't miss any comments. Oh, we don't want that. We don't want none of that. All right, we're gonna stop. We're gonna stop pushing buttons now. Boosting DSCR ratios. Try increasing your rents. Look at comps in the area. Look at some other properties. See what they're renting for. Try to be competitive, I would say. Take care of your property. You could possibly attract a higher paying tenant if your place looks well kept. Manicured lawns. Roof shingles not hanging off. having a nice remodel done, things of that nature. People do like to live in nice homes, and they will most likely pay more for comfort. So using comps, market rent analysis, you could also look into reducing operational expenses. And so maybe that's something like in looking into solar panels to possibly reduce your electricity bill. Maybe switching some services to some third party that still does a decent job of if that were something like I actually don't have a good example of that. I was actually thinking about like electric companies and them offering like a different service provider, but anyway, moving on. So let's talk about long-term rentals. When you're looking at a DSCR, so you can the way that we're going to calculate these rents is that rental income divided by your debt payments, and that's your principal, interest, taxes, insurance, HOA fees, that sort of thing, right? And so to find the estimated rent for the property, the lender is going to use, if it's a single family, it's going to be a 1004. If it's a multi-family, it's going to be a 1007. 1007? 1007. 1025 is for 5+ units, I believe. Yeah, so that's going to allow the appraiser to cover or to look at the market and see what properties are renting for, similar properties like yours. So long-term rentals are going to be a bit easier to find comps on, which can definitely help your DSCR, especially if rents in the area are strong. Now, that's going to be especially useful when they're looking at a vacant long-term rental, a property that is vacant, that you have purchased with a DSCR loan and you plan on renting out in the future. If the property is currently rented out, they're going to be looking at 12 months of your rent history. And so they're going to look at those lease agreements, see what the property is already renting for, and they will base it off of that. So with that being said, it's probably always a good idea to try and keep up with the market. If you can't, I mean, if you have some good tenants in there, you probably, won't really want to get rid of them. Not to say you'll be getting rid of them, but all right. Now, when it comes to short-term rentals, I like to recommend that people underwrite as a long-term rental first, and that's just because those short-term rental comps are going to be a little bit harder to find. That being said, if you do have your own short-term rental comps, be sure to see if you can provide them to the appraiser. And so you can help them get more accurate information, which can overall, help you get that better ratio. But when it comes to short-term rentals, there are a lot of restrictions. And so there's typically going to be a 5% LTV restriction, just because you have a lot more vacancies, you have off seasons, you still have to attend for repairs. Okay. And so when it comes to short-term rentals, lenders are also looking at the occupancy rate. That's going to be a big one. And so they're looking to see 60 to 70% occupancy. And the way they're going to figure that out is by going to AirDNA. They're going to push a button on there, and that's going to tell them what your property could potentially rent for, and it's going to tell them that occupancy rate. And so lenders rely pretty heavily on that, especially if your property isn't rented out. Even if it is rented out, they can sometimes still go off of that. They can also use both. So it really just depends on what lender you're working with, and that's what's going to determine that criteria of theirs. So just something to keep in mind on short-term rentals. And looking at those again, talking about risk factors. I have seen this a couple times where reserves have been the problem for deals. And so typically you're going to want to have 3 to 6 months of reserves on hand. Now, lenders have different requirements for this. And as you might have guessed, this can also factor into your interest rate because it can lower or increase the risk to the lender. So there is a lot of factors at play here, especially when it comes to that interest rate. You know, you got your credit score, you got the cash flow, um, and now you got reserves. And so, you know, having a good set of reserves is always a good idea. So of course there are lenders with no reserve requirements. 3, 6 months is pretty common. And then 12 months is like usually something I've seen where they have, you know, if you're doing, just for example, maybe you have a long-term rental and your credit score is under X amount, then you get, then you need to have this amount of reserves before you can refinance or something like that, or purchase. So hopefully that's an okay example that kind of gives you an idea of that. So when you're talking to your loan officer or your mortgage broker, so the difference being is that a loan officer would be able to offer you products from ABC Bank. Me as a broker, I would be able to offer you products from ABC, EDF, GHY. So a lot more options. I do the shopping for you. But when you're talking to one of us, you want to make sure that you're giving us all the information we might need up front, because it's really going to help us select what lender that we need to send you to that's going to be able to help solve your problem. And so if we don't have all the information, we could end up sending you to the wrong lender, which if you're trying to get a deal closed, as we all know, time kills all deals. And so that's definitely something that we're going to want to be cognizant of and make sure we're taking full advantage by being upfront. Overshare, you know, but try not to leave anything out that might be pertinent to the loan. So when it comes to Dscr products, I'm just going to be pretty honest that a lot of these products are the same. A lot of lenders are offering the 80% LTV, 20% down payment. It's very typical. I have one lender who's doing 85% LTV, 15% down payment. It is a new program they have. So excited to try that one out. But a lot of these programs are typically going to be the same. Where you're going to see the differences are with, you know, some of the nuances like the seasoning times, whether you can use gift funds or not. Gift funds are funds that are not expected to be paid back, and they are being literally gifted to you for a down payment. So easy example is if you're buying a home, and you know a family member is like, "Hey, here's some cash. Happy birthday, Merry Christmas, whatever." Not expecting it back. Here you go. That's a gift. So there are some stipulations around gifts. So that's something that you're going to want to check with your lender on. For instance, one type of restriction is that, you know, someone who's using, if you're using someone's gift funds, they will need to be part of your LLC. And I mean, while we're on the subject of LLCs, see, that is another thing that you should be talking to your loan officer about. So if you're planning on, you can close in an LLC. You can also close a Dscr in your personal name. If you're going to close in an LLC, you want to make sure the lender does not have restrictions on what is called a layered or nested LLC. And what that means is an LLC owns another LLC. And so that's something like that is typically done for protection purposes. But some lenders do have restrictions when it comes to that. So that's something you're definitely going to want to know up front. Something you're going to want to tell your loan officer up front. Let's see. Okay, what else? Wrong lender can set you back in time, energy, and effort. Some of the challenges with these loans going to be those reserve requirements. Meeting that 3 to 6 months mark. Six being that mark that you want to aim for. That's probably going to be healthiest. DSCR loans also do have prepayment penalties typically. And so that's going to be usually 1 to 5 years. So definitely, if you plan on holding the property long term, you may want to opt for one of those longer prepayment penalties. And that's because it can typically lower your interest rate. And that prepayment penalty is, if you decide to refinance the property earlier, it's going to get the lender paid back for that money they would have gotten had you kept the loan for that entire period. Now, some lenders also have it to where you can, like if you have a 5-year prepay, you can pay a certain amount. So like you could pay a point or something similar to bring that down to like a 1 year. So make sure, ask what your options are, ask if you can have it removed, because if you don't, the answer is always no. So it never hurts to ask, never hurts to try to negotiate a little bit. Let's see. Your credit score definitely does matter on these loans. So your credit score, your cash flow is going to matter. Pretty much if you have decent credit, a down payment, and it cash flows, you can get a DSCR loan. So they're not hard to get, but it's just something that you want to make sure that you are prepared for, and that you know what your end game is going to be. Try not to walk into really I feel like getting into any real estate without some type of plan. Okay. I'm trying to think if I missed any other topics. So I talked a little bit about the pairings. Pairings using DSCR with you can use it with gap funding. I didn't mention that. You could also use it with hard money. It's good for strategies like the BRRRR. So, fixing up the property, adding some value, and then refinancing to pull that equity out and doing it all over again. And so, the good thing with that is, your refinance proceeds could, for one, go towards your down payment. And for two, they could also count for your reserves. So with the right property and the right strategy, you could potentially continue to repeat with the BRRRR strategy. So I think that's a really great method. So gap funding would be good if it's not covering that. If the DSCR loan's not covering that full amount, you need some extra cash. Gap funding will literally come in and fill the gap. No pun intended. You can use it for 1031 exchanges. And so that is where you sell an asset and you need to buy another asset. You need to spend all of that money before you get taxed on it. And so you can use it for DSCR loans, or you could just plug it into another property. Lots of options. Just don't get taxed. That's the main thing, right? House hacking. If you're using now you can't live in the property with a DSCR loan. However, if you're using an FHA or a VA loan, I'm not sure if conventional has this restriction, but refinancing with an FHA or VA loan could lock you into the property for another year. And so that could really slow down your house hacking strategy. If that's the route you're taking, because when you get those loans originally, they're not meant for investment properties like people are using them for. They're meant for home buyers. And so they want you to actually live in the property, and they want to keep investors from, not taking advantage of some of these programs. And so with that, if you're going to do that refinance, you want to make sure that you refinance into another loan. And a great one in this case would be the DSCR. And that's because you could use your reserves for your down payment requirement. For your down payment, you could use your cash out for your reserves. You could use your cash out for your down payment. That is what I meant to say. But that will remove that restriction from you staying in the property for that extra year. And so that's a benefit there. Same thing with the VA loan, same premise. Now, there is a refinance that you can do that doesn't require that, but I'm not really going to dive too much into that. It is the VA interest rate reduction refinance loan, and that's for lowering your interest rate. So that's not really my wheelhouse. Of course, if anybody has questions on any type of loan, I am more than happy to find the answer for you. Carolyn, what's going on? House hacking with a bank statement loan. To be honest, I'm not sure, but I will find out. My thought is that you can, because actually, yeah, you can. I had a borrower ask me that a little while ago, and I had to confirm with Justin. So yes, you can, because you can use those for a primary residence. And so DSCR being for business purpose, you cannot with those, but bank statements you definitely can. Carolyn, how many bank statement loans do you typically deal with? I feel like I don't get a lot of questions around those, and I'd definitely like to find some pain points around them and make some content that can help some people, qualify for those loans or feel more comfortable using them as an option. It's all about adding more tools to the metaphorical toolkit. Pop over on Instagram. Okay, cool. Applications. Pad splits. Pad splits are pretty new. Maybe not to the. Oh no. Is he all right? Yeah. Sorry. Sorry. But I want to make sure he's okay. It's hacking up his lungs. I just lost my train of thought. Oh, pad splits. That's what I said. The investment world definitely might be, more familiar with the pad splits, but definitely in the lending world, it is still pretty new. So there's a couple lenders that can do it. I believe one of the ones I talked to, they would do it if you had 12. They would do the DSCR if you had 12 months of history with the pad split already. And I'm sure, maybe I'm hoping other lenders will start following suits and finding ways to allow some of those, because I think they're going to become a little more prevalent. Not many more DSCR and traditional loan products currently. Okay, cool. Well, if you have any DSCR questions, I would love to help you with them. Carolyn. Saban, what's happening, brother? Okay, so pad splits, hopefully becoming an option soon. Definitely open to having the conversation if you're looking to go that route. Uh, Section 8's Section 8's assisted living. Those are typically looked at as long-term rentals, and they're also good because they have some, guaranteed income, being that they are government programs typically. What's the other one? Section 8, assisted living, co-living models. I think that's pretty much all of them. Okay. All right. Wow. Well, I think I've hit all the bases on that. I'll have to put one of these together going over bank statement loans, and then maybe just kind of go through a lot of different investment type loans, and get some real education going. But if anybody has any questions, feel free to drop them in the chat. I'm trying to think of some fun facts. I probably cannot think of any. Someone just messaged me, and they are looking to get a DSCR loan. So I sent them my pricing form. They're not looking to get one anytime soon. They just want to kind of see what they'd be able to do, weigh their options, and then when they're ready to move forward, we can proceed. So it's good to help him out that way. He's actually he likes to wholesale, but also loves to keep the property. So nothing wrong with that. I plan on getting there eventually, but I'm going to get really proficient at this first, and then we're going to get into some house hacking. And then I'm going to start utilizing a lot of these loans for myself. I also plan to take full advantage of having a W-2 and having that bankability. Let's see, we got any fun things in here? Business use. I didn't cover that. If you're getting an appraisal, appraisals with DSCRs, you can actually save yourself some time. You can actually get an appraisal up front and transfer it between lenders. You just have to make sure that the lender that you want to transfer it to is going to allow it. And so, of course, that can save you some time. That can save you some money. Can save you a headache. Let you move a little bit faster with a little more efficiency. What else we got? 67% occupancy. Row comps. Yeah. That's all I got. Yeah. If you're on YouTube and you're finding this in the future, and you've got some questions, drop them in. I will come back. I will find them. I will find you, and then I'll answer your question. And we'll all be satisfied. We'll all live happily ever after. We'll run off into the sunset. Yada, yada, yada. Right? I hope everybody is getting ready to have a fantastic Christmas. So we are running into that week. Pop in some Christmas tunes and do your thing there. I have a lot of work ahead of me. A lot of brainstorming, a lot of figuring things out, a lot of getting things straightened out. I want to hit the new year running got a few things planned. I've got a few strategies I want to implement. It's a little overwhelming. It's a little frightening, but we're going to do it. And we're going to screw up a lot of things in the process. But we're going to do it. And it's going to be fun. And it'll be worth it. All right. Well, that seems to be the end. The people have filtered. And I believe I'm going to sign off. So if you're watching this in the future and you got value from this, like, subscribe, leave a comment, follow me on Instagram, Facebook, TikTok, getting on all platforms. So my name is pretty consistent, Chris_Dickerson, 23. Find me, check me out, ask questions. Have a great Christmas break. It's not like I won't see you tomorrow because I'll be back at 7 p.m. late and early. See you then.